Sorry guys, I'm just watching to see if we get a little sweep on the liquidity this time, because remember, we were hoping to get a little sweep of liquidity to try and get rid of these this top edge, the pesky weak sellers. And if we can get rid of those pesky weak sellers, then we can obviously see the price really making a big surge on the downside here. But that's what we're kind of looking for just now. Anyway, so coming back to this, we'd actually highlighted this chart a few days ago. We talked about the weakness of the 5s to 10s, and we suggested that there was a big possibility of short interest rates. Short interest rates. Why? Because the 5s 10s has got lots of room to get down to the 10s 30s, isn't it? So there's a lot of space here to get this market moving downside. Now, obviously, in line with that storyline, you can already recognize the story against this top edge. The 2s 5s is a very, very level-related bit of business because it's very, very much tied to the Fed. So we're already aware that this is one of the strongest areas that we can kind of look at in terms of opportunities. Well, that's the level that we got on the 2s 5s as the sell trade today. We'd already seen weakness on the 5s 10s. We'd already seen that weakness on the 10s 30s. So do you honestly believe that we're going to see a very, very strong CPI report when you're looking at that shape right there? Give me your honest appraisal of what you think is going to happen. If you're looking at that shape there, what do you think is going to happen? Well, let's just look at the possible scenarios. Let's think about the possible scenarios that's going to evolve at that point. Take a look. So there's going to be a couple of things, isn't there? There's got to be a scenario which we'll just do two scenarios. Good inflation numbers. When I say good, I know that causes a few problems. We'll change it to high. High inflation numbers. Secondly, a disappointing miss. A miss on inflation. So there's two scenarios, isn't there? If we've got good inflation numbers, if we're expecting good inflation numbers, one of the things that we'd probably have expecting to see on the run-up is we'd expect to see the 2s 5s here. Why? Because they generally work on actual data rather than forecasts. The forecasts are on the further end of the curves, aren't they? So we'd obviously start to expect that this is what the 2s 5s is doing here. So we can just put the 2s 5s into place here. At the same time as doing that, we'll do the miss on inflation as well. So we'll just draw the same line on the 2s 5s here. We're already getting a couple of clues by where I'm positioning, of course. Now, obviously, what's the 5s 10s hopefully doing? The 5s 10s in red is hopefully doing something else. The 5s 10s, one would hope, is doing this, right? For each of these two scenarios. So that's what you'd expect to see on the 5s 10s. Does everybody agree with this? Everybody agree with this? If we're looking at the 10s 30s, what would the 10s 30s be expected to be doing? Well, the 10s 30s, one would imagine, is going to be at the other extremes, isn't it? It's going to be at the other extremes. Now, obviously, there's always a response to this, and we'll go through the response in a second. There's always going to be a response, but we'll get to that in a second here when we just finish the drawing. Okay, so this is the good inflation. This is the miss on inflation. This is what we should be seeing running into the numbers, right? This isn't the number itself. This is running into the numbers. Because if we've got good inflation forecasts, it's coming from data, it's coming from background information, it's coming from noise in the background in terms of perhaps some real money data coming in from oil prices, commodity prices, input prices, output prices. So this is what we expect. Now, obviously, depending upon the number, because obviously we get into the number here, we get into the number here. Now, obviously, if it is a good number, and it's a very good number, and it beats expectations, what happens? Well, if it beats expectations, what's going to happen, of course, is the 2s 5s is going to shoot up. The 10s 30s is probably going to shoot down, depending upon how much the 2s 5s shoots up, right? The 10s 30s is going to respond to the 2s 5s at that stage. So we can obviously understand that that's what's likely to happen if it is a good number. If it's a miss on inflation, one would imagine what's going to happen is the exact opposite. We'll get a big sell-off on the 2s 5s, And that should probably steepen the 10s, 30s, because a drop in interest rates should have a knock-on effect at the 10s, 30s as a steepener, right? Because the 10s, 30s is nearly always a negative correlation. So we can already start recognizing this idea that we were forecasting a miss. Remember, this is the forecast phase. This is why we're forecasting a miss, and this is the actual traded phase. So this is a traded miss. Once we trade the miss, once we actually get a miss number coming in, we'd expect to see 2s, 5s selling. If we got a good number coming in, we'd expect 2s, 5s rising. So if this is what we're looking at, here, and we go back to this chart, what were we trading before the data? What do you think we were trading before the data came out, guys? A miss or a hit? Well, I've kept the colours the same. So the colours are the 10s, 30s, the 5s, 10s, and the 2s, 5s. So we were trading for the miss, weren't we? We were already positioned for the miss. Now, obviously, the data comes out and it misses, and then we get this big sell-off on the 2s, 5s. We get this big rally on the 10s, 30s, as you would expect. And that's exactly what's happened, isn't it? It's exactly what's happened. So we can tell going into the data what the market expects by looking at the forecast. A steeper 2s, 5s, or a flat 2s, 5s, really, it's not actually that steep. It's about flat compared to where it was before. In the background, you can see, obviously, it's the fact that the inflation is dropping here. Remember, the 2s, 5s doesn't have an inflation element. Well, it does a little bit, but it doesn't have that much of an inflation element. So it's this relationship over the last few days suggesting that there's a lot more downside inflation, and therefore that's starting to price in the 2s, 5s. Now, you might be looking at that and saying, well, why would that be useful to me? Because the good thing is, you know what the inflation forecast is on a macro scale, don't you? Because you can look at your Forex factory and you can actually look it up. And you can see in the week before the inflation numbers come out, you can look at the inflation numbers and say, what are they forecasting? And what does that mean I could be doing with this information? So based on that information, you could be saying, well, wait a second. Based on what I can see, I think I should be able to make money by buying treasuries this week. Because that's going to be the macro play, isn't it? Based on this pattern here, you're going to be thinking to yourself, well, there's going to be a lot of pressure on higher 2s, 5s, consistently higher pressure on higher 2s, 5s. So this should be a long bond trade, shouldn't it, when you think about it? This should be a very, very easy way to get some long bonds. Now, obviously, when we look at the long bond itself, this has obviously been this has been kind of visible since the beginning of this highest high point here. So from that point onwards, we should be able to make money by buying treasuries. So when we look at the treasury market on a macro scale basis, you can see treasuries have had a strong up phase, haven't they, during that period? Treasuries have had a very strong up phase. And you can see that if you had taken that macro decision based on these CPI numbers, you've been able to read that treasury long play literally for the last week or so. But that's a macro shout you've got to make, and it's not maybe in everybody's repertoire to make such a macro shout, but it should be, because it's not invisible. All you're looking is at the relationship of the 5s, mostly the 5s, 10s against the 2s, 5s. If the 5s, 10s are pulling away from the 2s, 5s, that's telling us that the interest rate storyline is under pressure. That's telling us that we're expecting to see a drop in short-term interest rates. And that's what we start looking for. We start understanding a drop in short-term interest rates. My God, I should be able to buy bonds and make a lot of money, right? That relationship is critical. But obviously, the reason why we then add in the knob spread is because we know how much knob spread is leading the 5s, 10s. Because if the knob spread starts reversing against the 5s, 10s dropping, that takes a lot of the pressure off the 2s, 5s. Because now the 2s, 5s is looking at the 10s, 30s and saying, well, actually, I think the fight spread is a little bit cheap. I think the fight spread might start doubling back. That's why we need to look at both the 2s, 5s and the 5s, 10s, but also adding in the 10s, 30s so that we can understand that relationship properly. When you understand that relationship properly, bond trading on a macro scale becomes incredibly basic and incredibly easy on a macro scale. It doesn't mean you're able to buy into any single drop or any single move, but it gives you at least a step for a hint about what is probably going to be happening on our inflation narrative. Now, obviously, we've talked about then checking the inflation storyline by looking at things like oil prices as well. And, when you start going back into that duration in the background, you start asking the question, well, what did oil do during that period? And you can see that in the background, oil had been kind of dropping off and had been stationary for some time here. So, we did obviously have this lift in oil prices recently. And that's obviously quite an interesting storyline, that lift in oil prices just there in line with what was happening, on the overall shape of the curve itself over the twos, fives. But, there's obviously a lot of questions about that oil price at higher prices, this idea of transitory inflation. The second thing, of course, is the equity impact. You can see equities has been on a very strong sell-off. So this is giving us a couple of pieces of information that if equity starts selling off, there's going to be more demand for buyers of bonds in terms of the spreads, isn't there? The hedge spreads to try and hedge out the deltas. People buy treasuries. So when you start slipping through some delta hedging areas on equities over the last 5 days or so, one of the key aspects that we understand is that buyers will buy cheap bonds. When that's confirmed by the shape of the curve, which is the 2s, 5s high, the 5s, 10s lower, and the 10s, 30s lower still, the question of whether whether the bond price will go up or down isn't a question. It's simply a statement. It's simply the bond price will absolutely go up. And our job, of course, as traders is to try and find a way into making that decision, find a way into making those very, very easy bond calls. Do not lose sight of the big picture, guys. Do not lose sight of the big picture. Absolutely critical to getting your bond strategy correct. We didn't make the 85 break. I suggested that the buyers were coming back in again, which was a little bit of a pity because obviously the big break for us is if we can get the oil price below 85. So it's bounced back up now at 71.11s. I'm waiting to see if I want to do any more business on oil today. I don't really want to be the guy that misses the break south if it does break south, but unfortunately the buyers are quite content to keep the market bullish at this point in time.